Good afternoon, and thanks for joining our webinar today. Again, this is Brian McGann. I'm the Head of Investment Strategy at Beacon Trust. We're grateful for such a strong turnout of registration today, and we want to get right into the presentation. But first, I wanted to take a couple minutes to reflect on the past 3 months. Our first quarter webinar that we did on March 10th was right at the onset of the COVID-19 pandemic here in the U.S. Financial markets had become pretty unsettled, volatility and anxiety spiked. Equity markets dipped pretty sharply, and fixed income yields fell to really unprecedented levels here in the U.S. Very certainly unsettling, to say the least. During this time, as the economy was basically shut down, we've had unprecedented stimulus measures. The Federal Reserve acted aggressively with a variety of measures on the monetary side, and the U.S. government acted pretty swiftly on the fiscal side to provide financial support for both individuals and companies. Thankfully, as we sit here today, we've witnessed a decline in cases, an improvement on the healthcare front in terms of treatment options, and progress on potential vaccines. And we're starting to see a gradual reopening of economies here in the U.S. and also around the world. In general, equity markets have made pretty good positive progress toward recouping the sharp losses, and volatility has subsided for now. While clearly we're not out of the woods, we'll be watching very closely as the economy reopens with the hopes that the positive progress continues. So joining me today are my colleagues, Dr. John Longo, Chief Investment Officer here at Beacon Trust, Susan Hayes, our Managing Director of Fixed Income, and Ermin Sivilak, who's our strategist who spearheads our asset allocation platforms here at Beacon. Before I turn the presentation over to John, I just wanted to cover the logistics of the call. Each caller is on listen-only mode for the duration of the call. Today's slides were emailed out to all who registered. They're also available as a handout on the right-hand side of your webinar screen under Handouts. If questions arise during the call, please feel free to enter those questions in that Questions tab, which is right on the right-hand side also of the webinar screen. And additionally, we're recording today's call, which we will post on the Beacon Trust website on the Insights section. So without any further comments, I'm going to turn the call over to John.
Thank you, Brian, and thanks everyone for joining us. As Brian alluded to, it's really been an amazing ride this year. If you told me the unemployment rate would be in the teens, that huge sections of the economy would be shut down, and the S&P would be basically flat year to date, I wouldn't believe it, but that's where we are. Let's start it with kind of the bad news, which, we're kind of moving ahead with that. GDP in this quarter is likely to be the worst since the Great Depression. You look at the range of estimates on the screen, it's probably somewhere in the mid-30s. But the good news is that as the economy starts opening, and we're reading stories every day about that, GDP will turn positive. So the market, as you know, is a discounting mechanism. It looks ahead, and the coast is, I wouldn't say clear, but it's clearer than it used to be. And I think that's one of the reasons for the market's rebound. Now, you've all heard about a V-shaped recovery. You've maybe heard about a U-shaped recovery. And here, the term that's called in the press is the swoosh-shaped recovery. It looks kind of like a Nike swoosh shape. So why this is relevant is that, yes, Q2 is likely to be dismal, dropping 30+%, and then we're likely to experience a significant rebound. But the essence of this graph is that it's probably going to take us a few years to get back to where we were in January. Another way of saying that is that the market has priced in a V-shaped recovery. Well, we're probably more in the camp of a U-shaped recovery or swoosh shape. So yes, the market may have gotten a little bit ahead of itself, but we think it's unlikely that the market will retest the lows, mainly because of the tremendous stimulus, both from the Fed and also from the central government. So it might take a while to get back to where we are, but the train, we think, has left the station and moving in the right direction. Now, I know there's a lot going on in this slide, but we know that COVID-19 has been a global pandemic. And this is just a quick snapshot of how GDP is affected around the world. So the bigger the ball or the bigger the bubble, the bigger GDP. So we know the US is the largest GDP, China second. And China historically has been growing at 8% per year. Now in 2020, expected to grow around 3%. And even though Q2 is expected to be down 35%, overall, if you look at point to point, January to December, US GDP is expected to be down around, let's call it 8%. That could be worse for Italy. So it just shows you it's kind of a global recession that we have. Now, we're starting to see stories of what the economy is looking like, and I'll show you some pictures of it. But one is, what are things going to look like in the interim during this so-called new normal? Well, one thing, if you're looking at the screen, is temperature checks. Now, all of us know that sometimes we go to a sporting event, they have a metal detector. When you go to the airport, they check a number of things as well, and they might want to check your temperature as well. When a child goes to school, sometimes they have to show proof of vaccination, and that might be the case with COVID. Either you have a vaccine when it hopefully comes soon, or you've had in the past and have recovered. So bottom line, the economy is not going to be what it was in January until really we get a vaccine that's widespread. Now, what's somewhat interesting about this is that the way COVID spread is that we have a little bit of a heads up what's happening around the world. We know it started in China, spread to Europe, notably Italy, and then made its way to the US and now in Latin America. So we can see a little bit what's happening around the world, which gives us a glimpse of what might be happening in America. So I think many of us are anxious to get out to restaurants. What might that look like is that there might be less capacity, there might be barriers between tables. Your server, instead of wearing a mask, might be wearing a visor. And many of us with children are wondering, when will our kids go back to school? What will it might look like? And you can see here in the Netherlands, kids separated by plexiglass. Some of us travel to New York City. You might have some trepidation about taking the subway. And you can see in Colombia, they're having space. I don't know if you can be 6 feet apart in subway, but you can certainly have some distancing. In the subway station here in Paris, you can see these are 6 feet apart. I'm looking forward to the summer movie season. And you can see in Prague, there's adequate social distancing. And maybe waiting online at McDonald's, there are spaces a few feet apart. Now, we all know that some of the hardest hit industries have been retail, airlines, entertainment. So I know there's a lot going on the screen, but I can simplify it for you. Roughly 20% of the jobs in the country are in these severely affected industries: restaurants and bars, retail, hotel, tourism. They account for roughly 19% of GDP, but only 7% of earnings. So this is another reason why the S&P is roughly flat year to date, that the most severely affected industries account for only a small fraction of earnings. We know that firms like Apple and Microsoft drive the lion's share of the earnings. Now, it was an amazing, just from an educational standpoint, how quickly the market fell. Some of you that are students of market history might say, what about the crash of 1987, where in Black Monday, October 19th, 1987, stocks fell 22% in one day? That's true, but you may recall that stocks in 1987 started falling a little bit earlier in the year, and they fell pretty sharply on the Friday before the crash of '87. So make a long story short, this bear market that we had, that we may indeed be exiting from, was the quickest on record. It took 16 days to drop at least 20%. And I think this is one of the reasons why we rebounded so quickly. Now this is, excuse me, one of my favorite websites called finviz.com, stands for Financial Visualization. And I'm going to show you two pictures. This one is S&P performance year to date by company and by sector. And as I alluded to, there are some industries that weren't affected too badly. In fact, we know that Netflix and Amazon benefited from a huge surge in business. And Microsoft did well. Microsoft, we're doing more and more software at home. They have a competitor, Zoom, called Team. So the bottom line is that the S&P is made up of many stocks. And the large mega cap stocks have actually done okay. So the median stock is still down around 10% year to date, even though the S&P is flat. So this talks to a lot of things: stock picking, large cap versus small cap, and other things that my colleague Erman will cover near the end of my remarks. This is a similar website, finviz.com, but here they're looking at valuation. The most common valuation metric that maybe you've seen in the stock pages of the Wall Street Journal is PE, price to earnings ratio. So this kind of shows that, yes, there are some expensive stocks. Amazon's probably kind of expensive, but it's also growing quickly. But yet there are pockets of value. We see healthcare, which I think is well situated regardless of the election, and we can chat a little bit about that near the Q&A section, trading at reasonable valuations. The phone companies are trading at reasonable valuations. Financial service stocks at reasonable valuations. So despite the great bounce we've had off of the March lows, I still see some pockets of value. Now, this is a nice slide from an educational perspective, and by and large, most of our clients stayed the course, stayed to their diversified portfolio, and were able to capture all or the bulk of the rebound. And this is just a slide of what is the average drop over the past 40 years, and what is the largest drop on a year-to-date basis. So in 2020, from top to bottom, the market fell 34%. As of this webinar, it's down about 1%. This 34% drop is the largest since the Great Recession, where we fell almost 50% top to bottom. So bottom line, there is always volatility. Volatility clearly went up this year. We were expecting that. We obviously didn't forecast a pandemic, but we thought volatility was abnormally low. And the message of this is that in most years, a diversified portfolio helps out. It helps you stay the course and not panic during the market lows. And fixed income has had an excellent year, as Susan Hayes will talk about in a few moments. Now, Brian alluded to some of the stimulus, and I've mentioned it as well. And perhaps the linchpin or centerpiece of the stimulus was the CARES Act. Amazingly, many Americans got a check in the mail, over $300 billion directly. Corporations got, in some cases, a forgivable loan. The airlines and cruise lines are among the most notable. Small businesses are getting money. State and local governments, it's been a little bit delayed getting them the money, but they're in the queue, as well as others. So this $2 trillion is one of the things that I think is driving the market, has got it off the lows, and has resulted in GDP gradually recovering. And by the way, we officially entered the recession in February. That just came out yesterday. And I think we're probably out of the recession as we speak in June. I alluded to the Fed's massive response. It's been even more significant than what they did in the Great Recession. Just looking at some numbers on the screen, the Fed's balance sheet was $750 billion before the Great Recession and Lehman went under. Through a series of quantitative easing measures, that's what QE stands for, the Fed increased its balance sheet from $750 billion to over $4.5 trillion. And as we speak, the number is close to $6 trillion and could go to $9 or $10 trillion. So this is having a number of effects. It's reducing panic in the market, which I think is important. It's reducing credit spreads, making the capital markets open to businesses. It is also making it easier, perhaps, to refinance a mortgage, at least those with a decent credit rating. So the Fed is truly acting as a lender of last resort. And that's a perfect segue for me to hand it off to my colleague, Susan Hayes, who's our Managing Director and Head of Fixed Income, who will talk more about what's happening in the fixed income markets. Susan?
Thank you, John. Good afternoon, everybody. I'd like to start off with an overview of what happened in the fixed income markets over the past few months in response to the coronavirus-induced economic downturn. There's a lot to unpack. There's a lot of events that happened, as John alluded to, but I'll try to explain it briefly here, as there has been an unprecedented amount of volatility in the last 3 months in the fixed income markets. I think one of the most notable events in the fixed income markets, especially in March and April, was the speed with which fixed income assets sold off, including everything from the highest quality bonds to the weakest quality bonds in the span of only a couple weeks beginning in early March, when the virus was spreading quickly and the economy was effectively shut down. At one point, the market was so seized up that market participants couldn't even get a bid on U.S. Treasuries, which are perceived as the most liquid security in the world. So as markets began to break down in March, the Federal Reserve acted quickly and decisively to calm markets. And it really can't be underestimated how this early and proactive intervention by the Fed helped to restore some semblance of normalcy to fixed income markets. And the Fed deserves a lot of credit for proactively solving massive problems in every corner of the credit market. But as much as the Fed was instrumental to calming markets from a monetary perspective, it was really a two-prong approach, as John showed you in his slides, from both the monetary side and the fiscal side that ultimately led to recovery in risk assets. I'll cover both sides here to clarify the extent of the aid. As far as the monetary response or the Federal Reserve, this really had the most immediate effect on credit markets. So at the height of the market dislocation, Fed Chair Powell promised to do whatever it takes, and he really stuck to his word. So among the different things that he did to try to calm markets were 2 emergency rate cuts to take the Fed fund rate down to 0. He committed to unlimited amounts of U.S. Treasury buying or quantitative easing, and the Fed also pledged its balance sheet. It was at $4 trillion, and it now stands at about $7 trillion. So they instituted many programs to help the economy recover. One of the most important moves that the Fed made at the height of the crisis was to implement special lending facilities. Some of these had the backing of U.S. Treasury, and they tackled everything from backstopping money markets and the corporate bond market to helping to facilitate short-term borrowing for state and local governments and helping small and medium-sized businesses. In total, the Fed launched 9 special lending facilities, and they really helped to calm the markets. They directly affected the positive price performance in investment grade and high yield corporate bonds, as well as municipal bonds. So in total, the Fed committed $750 billion to these programs. The Fed prioritized buying exchange-traded funds, or ETFs. This is their first foray into actually buying bonds in the corporate bond market. So they agreed to buy investment-grade ETFs, which makes sense because they're higher quality. But as a surprise to many in the market, they also agreed to buy high-yield ETFs. Additionally, the Fed said they stand ready to buy corporate bonds directly from companies if need be. So all of that intervention on the corporate bond side immediately had the effect of making the market rally and making everybody feel better about investing in corporate bonds. On the municipal side, the Fed also announced a $500 billion emergency program called the Municipal Liquidity Facility on April 9th to help with cash flow shortages caused by revenue shortfalls due to coronavirus shutdown in the state and local government sector. Much like the corporate bond market, this was welcome news in the municipal market and led to a strong rally in the tax-exempt space. So as John mentioned, it was really a two-prong approach. The second prong was the fiscal response in the form of the $2.2 trillion CARES Act that John covered a minute ago. The unprecedented level of aggressive fiscal and monetary support that was given by the Fed with the help of Treasury and Congress really served to head off what could have been a financial calamity not seen in our lifetimes. And I do agree with John that it felt much worse than it was in 08-09. I think it's worth noting that a lot of the stimulus that has been pledged through the CARES Act and different avenues haven't even been deployed yet. So at least the fixed income market has felt better because of some of these programs starting to flow through the markets, but there's a lot of programs that haven't even been released yet. One of them is the Main Street Lending Facility, which has been in the news a lot lately. So we think the market will feel even better when all of the stimulus actually flows through the market. So I'd like to cover our interest rate outlook and Federal Reserve action going forward. Fed Chair Powell at the height of the crisis says, he's committed to doing everything possible to calming markets, and they are committed to keeping rates low for a long period of time. So I don't think that we should expect material higher rates in the near term, especially due to the fact that we are in a recession and the economy may take 2 years or longer to fully come back, and the Fed is committed to keeping rates low to keep lending going. 10-year treasuries are trading around 83 basis points now, up from, as Brian mentioned at the beginning, around 35 at the height of the crisis. So that's some welcome news. Rates are still low, but they are inching a little bit higher the better the market feels. So we expect treasuries to trade in a range of around 75 basis points to 1.25 basis points for the foreseeable future. And the Federal Reserve is meeting today and tomorrow and will give its rate decision tomorrow. We don't expect them to change rates at this meeting. We think it'll be status quo. We do expect them to give a little bit more guidance around their stance on negative rates and discuss yield curve control, which is a new term that's been bouncing around the market. At Beacon Trust, we manage the fixed income portion of the portfolio to act as ballast for the overall portfolio and advise that if we encounter times of equity stress, the fixed income should fare well comparatively, as John mentioned. This is exactly what happened in the first quarter as stocks hit their lows and uncertainty around the future path of the virus and the economy wasn't clear. Both of our taxable and tax-exempt portfolios fulfilled that function and performed very well. I'd like to cover the municipal market quickly. So the municipal market, despite all of the fiscal and monetary intervention, municipalities are facing headwinds from reduced revenue due to COVID shutdowns and budgetary shortfalls, as well as increasing spending brought on by the pandemic. So unlike the federal government, municipalities just need money. They need to stick to a balanced budget mandate and can't run deficits. So in difficult periods of time, they have to cut budgets and in some cases raise taxes in order to balance the budget. So there has been more stimulus proposed for direct aid to state and local governments in addition to what they've already received from the CARES Act, but it hasn't been decided so far, and there is some resistance to it in Washington. I want to note that in our portfolios, we only own safe sector bonds. So these are the types of bonds that are essential to the community, essential revenue, water and sewer, and general obligation. And owning these safer sector bonds really help the portfolios during times of turmoil. I think knowing what you own, doing the credit research and the diligence is of the utmost importance right now. And just as the market as a whole, people ask me all the time, is there value in the municipal market right now? And I do think there is value, especially for clients in high tax brackets, and when you look at them versus treasuries. So the municipal market does have some value right now. I want to also mention the corporate bond market. As I mentioned earlier, the Fed intervention and liquidity backing had the effect of fixing the market in short order and inducing a rally in both investment grade and high yield corporate bonds. So there's been massive issuance in the corporate bond market lately as companies have sold $1 trillion in bonds at the fastest pace on record. They're rushing to bolster liquidity and issue debt at yields at all-time lows. But the record issuance in the corporate bond market has been met by insatiable demand as investors feel comforted by the Fed's backstop. So on the credit front in the corporate bond market, same thing as the municipal market. You should know what you own and beware of over-leveraged companies. So to conclude, in our client portfolios for both the taxable and tax-exempt strategies, our conservative high-quality bias has been beneficial during this period of volatility. We do anticipate that the overall portfolio performance numbers will probably be muted towards the end of the year because we've had such a strong rally over the last 2 months. But overall, we're pleased with how the portfolios have performed thus far. And with that, I'll turn it over to my colleague, Ermin Sivilek.
Thanks, Susan. As it is always the case in any particular calendar year, 2020 investment results so far show many leaders and laggards, even though the market overall, S&P 500, is relatively flat year to date. Not every style and sector performed the same, and I'd like to highlight a few select outperformers and underperformers over the past 5+ months, which has seen record level of market volatility and some very unusual activity, as Brian alluded to earlier. So starting with the growth stocks, the big tech companies, which make up a good portion of the growth universe, generate very high profit margins and cash flows from their underlying businesses. And this is especially true for the 5 largest tech companies: Facebook, Amazon, Google, Apple, and Microsoft. They use this cash to lead in innovation and add to the leads in market capitalization. So the products and services that they sell, whether it's e-commerce, cloud services, social media, or cool devices we all like to use, are in high demand. Now, there are potential risks ahead, whether it's regulation, antitrust investigations, or higher taxes that could slow the tech momentum, but we remain bullish on high growth companies in tech and healthcare and their ability to continue to innovate and lead the financial markets. As some of you may know, we've been adding opportunistically to innovative growth exposure in our portfolios. The other point I like to make about growth stocks is that they tend to do well when interest rates and economic growth rates are relatively low, as they are now. That's when growth stocks trade at a premium due to scarcity of the overall earnings growth. So to some, NASDAQ index, which is representative of the growth stocks, is up 11% year to date, and it's been a big leader in 2020 so far. Next, we can mention the large cap stocks as a winner year to date. Companies that have larger market capitalization, especially those with high quality characteristics such as strong balance sheet, stable earnings, high return on equity, low debt, they typically hold up well when the market turns downward. And this is due to having more diversified revenue sources, higher cash balances on their books, and lower overall uncertainty on whether they'll remain solvent and survive an unprecedented public health crisis that we've been facing in 2020. Lastly, gold is an uncorrelated asset with limited supply and high current demand currently due to the economic uncertainty that we face, due to massive liquidity injections by central banks around the world, which can lead to lower currency valuations. When you have too much of something, that something eventually is worth less. Gold is also benefiting from ultra low interest rates and the need to hedge against potential inflation in the horizon. Gold can also work well when there's a deflation and uncertainty. So it's a great portfolio diversifier with no correlation to stocks and bonds, and it's outperforming both equities and fixed income by a substantial margin. It's up about 13% year to date. Moving over to underperformers year to date, first one I'd like to talk about is the value stocks. Russell 1000 Value Index, which is an index of lower PE stocks, is down about 9% year to date. International equity markets, which often trade cheaper than US equity markets, can also be seen as a value play, and they're also trailing the S&P 500 large cap US index year to date, and international stocks are down 7%, a little bit better than US small cap stocks. A good portion of the value stocks represent companies that pay out above average dividends, and dividends in 2020 are somewhat at risk. Due to the COVID-19 related business disruptions, these companies have significant drops in revenue, and in some cases they can no longer afford to pay high dividends, which eventually hurts their share price. Also, another factor that's contributing to underperformance of the value stocks is the financial sector, which is the largest weight in most value indices with approximately 22% allocation. Financials also represents the largest sector exposure in international equity markets. And as you may know, banks haven't been performing all that well, and that's really due to two reasons. First, there is an expected rise in delinquencies and defaults, as we often see during recessions. Also, we're living in a zero to low interest rate environment, which makes it a bit challenging for banks to generate meaningful revenue and revenue growth. That being said, we're seeing some encouraging signs of value stocks participating, and in some cases beginning to lead growth stocks over the past 2-3 weeks as we begin to open up the economy as we begin to recover from the COVID-19 crisis. And it may be a short-lived recession. Value stocks, after all, perform well during economic expansions as they are highly exposed to economic growth. So I think the future is brighter for value stocks than the past 5+ months. Next, I'd like to talk a little bit about small cap stocks. Small cap universe, just like value style, is also down 9% year to date. And the reason is smaller companies with more limited financial resources compared to the larger counterparts have been especially hit hard during the current pandemic. These businesses typically have higher leverage levels, harder access to capital, which puts them in a vulnerable position during recessions. But just like the value stocks, we're beginning to see the green shoots, and the outlook for small cap stocks is getting brighter. Small cap index, which is tracked by Russell 2000, currently holds 23% in healthcare stocks, which is another positive element for the future returns, because many of these small healthcare and biotech companies are involved with developing coronavirus vaccines, which is helping their share prices. By way of comparison, S&P 500, which is the large cap index, has only about 15% exposure to the healthcare sector. And lastly, last point I'd like to make about the small cap stocks is, coming out of recessions, they perform relatively well. In fact, they outperform large cap stocks in 9 out of the last 10 economic recessions. Lastly, I'd like to say a few words about energy, which has been going through a roller coaster ride in 2020. Wrapping up the month of May, last month, crude oil prices rallied 88% in the month of May, which was by far the best month on record. And it was a result of states and countries opening up around the world, as well as supply cuts instituted by OPEC. However, oil prices are still down about 40% from the January high of $66 per barrel. In fact, we saw for the first time negative oil prices ever in April, when the COVID-19 was at its peak. Economies completely shut down, airline and hotel usage rates down 90-95% from the previous year. And negative prices imply that you have to pay someone to take the oil from you because you have nowhere to store it. That's how low the demand was in April. But what we typically see in commodity markets after such volatility is the market eventually finds an equilibrium price, and that comes through a combination of lower supply, including, unfortunately, some energy companies going out of business, others perhaps cutting down sharply on production, as well as higher demand as airlines eventually start flying at much higher capacities, factories open up, and consumers resume their normal activities. So those are some of the highlights in terms of mid-year 2020 financial markets performance. So I will now turn it over back to Brian to see if we have any questions from clients.
Thanks, Herman. Thanks, Herman. Thanks, Susan. Thanks, John. A lot of great content, as always. We did have a few questions come in during registration. So a lot of the points we hit, but if I could keep Herman on the spot here for a second, there was a question for the outlook for gold, which I think we've already covered. But can you make a couple comments on real estate and an outlook for real estate over the next 12 months?
Sure. When it comes to real estate, as real estate agents say, it's all location dependent, it's all local, and my response is it depends on the sector. Certain REIT investments, real estate investments that specialize in cell phone towers, for example, or industrial storage facilities that are used to store products used in e-commerce, they're actually doing very well for reasons related to a boom in e-commerce and cloud computing. On the other hand, retail malls and commercial office buildings are struggling. They're suffering from a reduction in foot traffic in malls and higher vacancies in commercial buildings. Residential real estate is the big unknown. If there's a new trend emerging for people to leave big cities and move to the suburbs where they can work remotely, we could see home prices in suburbs appreciate at the expense of properties that are located in perhaps the central business districts of large cities. But nationally, we don't expect a meaningful drop in home prices as a result of what will be a short-lived recession, as long as the recession is not long-lasting and severe. And that's certainly not our base case scenario. Last point, and perhaps at the national level for residential home prices, is that they should continue to appreciate at the rate of inflation. That's what home price appreciation is over the long term, rate of inflation. And perhaps cities like Phoenix, Charlotte, and Tampa should appreciate at higher rates due to higher job growth trends that are taking place in such cities.
Okay, thanks. And then finally, one other question that I think I'll address, and John had alluded to this also in his comments, is the potential for the markets being slightly ahead of themselves and a sort of a second wave of decline coming in. And again, I think volatility will continue to be very visible as we head through the summer months with the reopenings of the economies and a little bit of fits and starts. And as I commented before, we're looking really for the positive progress to come through. And then we're going to have, what we thought was going to be the biggest volatility driver of the year would be the presidential election coming up in the fall. So we have a lot to look forward to there in terms of drivers of volatility. But really the second wave of declines and retesting the lows, we do believe with the, again, just the tremendous amount of stimulus that's been enacted. Susan made the comment that a lot of the programs that have been passed haven't even been deployed yet. And then the talk still on the government side with another wave of stimulus coming in potentially to be voted on sometime in July. We think that that in and of itself should give us some level of comfort that we won't have another sharp decline. Plus, also on the positive side, we've seen great developments in terms of the healthcare front. So I do think that the potential for another mandated shutdown of the economy is probably pretty low at this point. And then one final point that I think I'll ask John to comment on is, given the high unemployment rate, is the rally in not only the markets but the potential for the economy, given the high unemployment rate, what's the sustainability of that?
Yeah, thanks, Brian. I think this goes back to one of the earlier slides that I had, that our view is that the economy is in this kind of U or swoosh-shaped recovery and not the V shape. And the reason for our rationale is that we know that in the US, the consumer is about 70% of the market. So if the unemployment rate is still elevated, and even at the end of the year, it's probably going to be in the high single digits, it's hard to see the economy as strong as it was in January. So, that being said, if you look out for a 2 to 3 year period, which most of our managers do, it's likely that stocks are going to outperform bonds. As Susan alluded to, fixed income and cash is there as ballast in the portfolio. And we know that short-term rates are 0, long-term rates are 1% at best. So over time, investors will gravitate towards the stock market. That being said, I continue to expect volatility. We have an election coming up that's very contentious, very different policies. And that's why we have a diversified portfolio, to kind of ride out the volatility and stay to the long-term plan.
That's great. I mean, I think we're bumping up against about almost 45 minutes on the call. So at this point, I would really like to thank the registrants and participants and clients that are on the phone for taking the time, listening to our outlook, and being supportive of Beacon Trust. We certainly are open. We've been open and accessible through this entire interesting time period. Again, a true testament to the innovation and technology that's available to us now, where we've all been pretty much working remotely and in close contact with clients at all times. So please, if anything comes up or you think of anything after the call, please feel free to reach out to your respective advisor or teammate here at Beacon Trust. And again, we'd like to thank you for your time. And again, a thanks out to John and Susan and Ermin also for your insightful comments. So we'll wrap it up there. Everyone, please stay healthy and enjoy what hopes to be, looks like a beautiful week. Thank you very much.